Hi, this is going to be a homework walkthrough for Chapter 12-2. We will start with question 1. The management of Unter Corporation, an architectural design firm, is considering an investment with the following cash flows. And they give us the investments in year 1 and 2, and then the cash inflows in years 1 through 10. And they want us to determine the payback period of the investment. And then required 2, would the payback period be affected if the cash inflow in the last year were several times as large? So we will figure that out. So the first thing I'm going to do is I'm going to fill in all of this information. So 56,000 and 6,000. 2,000. That's wrong. Okay, so here's 1 through 10. I added totals just for the fun of it. So the first thing we need to figure out is just kind of go down and figure out how much of this investment is unrecovered. So in year 1, we're going to take the investment minus the cash flow, because the cash flow is what we're using to pay back. And then in year 2, it's a little different because we have what was unrecovered, plus we added another 6,000, and then we paid back 4,000. So if you look at year 1, it's just the investment minus the cash inflow that we used to pay back a portion. Year 2, it's the unrecovered portion of the first year's investment plus the added investment in year 2 minus the inflow that we used to pay back a portion. And now years 3 through whenever it's paid off are going to be the same. So it's going to be the unrecovered minus that year's inflows. And so I can drag that down. Okay. So right here, so I'll show you. I dragged the formula down, but it's essentially the same. It's the unrecovered from year 3 minus the cash flow inflow from year 4, and so on down. So year 5, year 4 is unrecovered minus the money that came in year 5. And I keep going down, and I could, if I drag it one more, then I end up with a negative value. So I know that I'm going to stop the year before, so year 8, and then I'm going to finish paying it off in year 9. And so the definition of payback period equals the number of years up to the year in which the investment is paid off plus the unrecovered investment at the beginning of the year divided by the cash inflow of the payoff year, right? So for mine, it's the year before is 8. So I'm going to do 8 plus 3,000 divided by 5,000 because that's my inflow for the year I'm going to pay it off. And so in my payback period, I'm going to go equals 8 years plus parentheses, the unrecovered divided by the payoff year's cash inflow, close parentheses. So for my answer, it's the payback period is 8.6 years. Round your answer to 1 decimal place. So even if it's 0, put 8.0, whatever it is, 1 decimal place. Okay, so required 2, the question is, would the payback period be affected if the cash inflow in the last year were several times as large? So the last year, what they're talking about is year 10. Say in year 10, if we had a cash inflow of $15,000 instead of $5,000, would that change my payback period? And the answer is no, because it is paid off before that final year even comes around. So that will not affect my payback period at all. Okay. Question 2. All right. The following information applies to the questions displayed below. Nick's Novelties Incorporated is considering the purchase of new electronic games to place in its amusement houses. The games would cost a total of $680,000. Okay, so I'm going to put that down here. So there's my initial investment. Have a 15-year useful life. 15 years. And a total salvage value of $68,000. So salvage value of $68,000. The company estimates that annual revenues and expenses associated with the games will be as follows. So I'm going to copy all of this information down here. So my revenue is $250,000 right there. And then my commissions to amusement houses is $60,000. My insurance is $35,000. Depreciation of $40,800. Maintenance is $70,000. And they must have added up those expenses. Let's see if I come up with the same number they have. Yep, so 205,800, and then net operating income, that by definition is the revenue minus the expenses, for 44,200. Okay. Now, in this example, they are going to add in depreciation because they're looking at this from an accounting standpoint, not from a actual cash inflow standpoint. I believe that is why we're adding in depreciation. And so we will take depreciation and add that back in because it was subtracted out here. And so our annual net cash inflow. Oh, okay, sorry. I said that backwards. Okay, so in this instance right here, this balance has depreciation subtracted from it. Depreciation is something that is on the books. It is not a cash transaction. We don't go pay somebody depreciation. It's just an accounting tool used for tax purposes to depreciate the value of equipment over time. And so we need to add that back in to get our actual annual net cash inflow. So actual dollars that are coming in. So that's why we add that back in. So this plus this for 85,000. Okay. Now we are going to, let's see, the definition of payback period in this instance is the initial investment divided by the actual net cash inflows. So that's why we don't worry about depreciation, because it's not cash, it's just on the books. And so we need the actual cash coming in. And so payback period is going to be equal to my initial investment for the games divided by my annual net cash inflow. So for mine, it's 8.0 years. 1B, assume that Nick's Novelties Incorporated will not purchase new games unless they provide a payback period of 5 years, 5 years or less. Would the company purchase the new games? Well, I just figured out it's going to take 8 years to pay this back, so no, they would not do it because 8 is greater than 5. Okay, question 3. Okay, same company, same information, and so I'm just gonna again put this down here. So it was 680,000 was my initial investment, revenue of 250,000, commissions. Okay, so that's all that information that they gave me right there again. So now they want to know what is the simple rate of return promised by the games. And so now this is something where they're just sheerly looking at things from an accounting standpoint, not actual cash inflows. So simple rate of return, we will leave depreciation as a part of this. And so the definition of simple rate of return is net operating income divided by the initial investment. And so that is going to equal that 44,200 divided by the initial investment. So and this is a percent, so round it to 1 decimal place. So if you have something like 0.065, then you make it a percent to 1 decimal place. So 6.5%. Okay. If the company requires a simple rate of return of at least 10%, will the games be purchased? Again, I just figured out it's 6.5%. That is less than 10%. We're talking about a rate of return. So we want it to be bigger because it's money we're making. And so the answer is no. And the clue there is of at least. So it has to be 10% or more for us to do it. Okay. Question 4. A piece of labor-saving equipment has just come onto the market that Mitsui Electronics Limited could use to reduce costs in one of its plants in Japan. Relevant data relating to the equipment follow. Purchase the cost of equipment. So there's my initial investment. In this case, annual cost savings that will be provided by the equipment. That is our cash inflow, if you will. Now they're calling it a cost savings. So that's going to be our positive value. And the life of the equipment is 10 years. So compute the payback period for the equipment. So my purchase cost is 494,000. My annual cost savings is 95,000. The life of the equipment is 10 years, just so I have all of that data, because I'm sure I'm going to need something later. So payback period, that is the initial investment divided by the cash inflow or the cost savings in this case. So, and round it to 1 decimal place, and it's just a number. It's not a percent. It's not dollars. It's just 5.2. Okay, if the company requires a payback period of 4 years or less, would the equipment be purchased? Again, 4 years or less, so it would be 4 or fewer. And that we just figured it out, it's 5, so the answer is no, they would not do it. Okay, simple rate of return. So we have to figure out, again, simple rate of return. We're going to subtract depreciation. So annual cost savings is 95,000, and my depreciation is the purchase cost of the equipment divided by 10 years because it's straight line depreciation. And so my annual incremental net operating income is that minus depreciation. So 45,600. So again, simple rate of return is going to be equal to net operating income divided by the initial investment. So 9.2%. And remember, this is a percent rounded to one decimal place. Would the equipment be purchased if the company required a rate of return of if the company's required rate of return is 14%? Well, no, because it's 9.2% and this is rate of return. That's money I'm making, and it's not 14%. So the answer is no. All right, that's the end of homework 12-2.